Welcome back to Plan Future AI Insight. I am your Investment DADA, and today we are addressing one of the most critical psychological traps in behavioral finance, a mistake that separates patient, wealthy investors from those who lose out on life-changing returns. We are talking about what happens when an investor pauses or stops their SIPs during a market crisis, and how that emotional reaction alters your long-term financial planning. What an incredibly thoughtful question. I am genuinely proud you are asking this now. Most people only realize the gravity of this mistake after the market has fully recovered, leaving them behind. Let's look at the hard data and behavior mechanics to see exactly why a crisis is the worst possible time to hit pause. The hard numbers: what's stopping your SIP costs you. Let's look at a realistic, practical scenario. Suppose you are investing 10,000 rupees a month in an equity mutual fund allocation, targeting an average 12% annual return over a 15-year horizon. Scenario A, the disciplined investor: you stay completely invested through thick and thin, through every market cycle and terrifying headline for the full 15 years. Your total out-of-pocket investment is 18 lakh rupees. At a 12% average return, your final retirement corpus grows to 50,46,000 rupees. Scenario B, the panicked investor: during a major market crisis around year 5, you panic and stop your monthly SIP for just 12 months. You miss out on buying when prices are at their lowest point. You eventually restart, but you missed a full year of accumulation at deep discounts. Your final corpus drops to roughly 42 to 44 lakh rupees. That brief 12-month emotional pause costs you between 6 to 8 lakh rupees in final wealth. This happens because stopping an SIP doesn't just mean you missed out on 12 months of contributions. It means you actively denied yourself the explosive compounding power of low-priced units bought during the market bottom. Upward trend: the mechanics of rupee cost averaging. When markets crash, the absolute value of your portfolio drops on paper, which feels uncomfortable. But structurally, a falling market is an accumulator's best friend due to rupee cost averaging. Think of it this way: if a mutual fund's net asset value is normally 100 rupees, your 10,000 rupee monthly SIP buys you exactly 100 units. If the market experiences a sharp 30% crash, that now drops to 70 rupees. Now, your same 10,000 rupees automatically buys 143 units. You are getting 43% more asset share for the exact same amount of money. When the market eventually rebounds back to its normal level, those extra units accelerate your portfolio's recovery velocity. If you stop your SIP during the crash, you freeze your portfolio at the absolute worst time, buy 0 cheap units, and completely miss the eventual market liftoff. Gem Dada Wisdom Session: Math versus Temperament. Over my 20 years of observing market cycles, I have come to realize that successful long-term investing is 10% math and 90% temperament. The mathematical logic of keeping your SIP active during a downturn is completely undeniable: lower purchase prices, higher unit accumulation, and stronger long-term compounding. But the human brain is wired to run from perceived danger, screaming at us to stop the bleeding. This psychological hurdle is exactly why navigating a crisis with a trusted professional or distributor acts as your ultimate financial safeguard. When panic hits the headlines, you need that voice of reason to remind you: stay calm. This is a temporary dip. Your monthly SIP is simply buying high-quality assets on a massive monsoon discount right now. The investors who build true, generational wealth are never the ones who try to perfectly time the market's peak or trough. They are simply the ones who refuse to turn off their investment engines when the road gets bumpy. Dada's action plan for market volatility: automate the process. Ensure your monthly SIPs are completely automated via standing instructions. Removing the manual step removes the emotional hesitation. Build a liquidity buffer. Maintain a robust emergency fund equivalent to 6 to 12 months of expenses. If you have plenty of safe cash on hand, you will never be forced to pause your long-term growth assets for short-term cash flow needs. Change your perspective. View a market correction not as a loss of current value, but as a rare wealth-building window to acquire more units at a bargain. Dada Wisdom of the Day: running a SIP during a market crash is like sowing seeds during a heavy monsoon. It feels messy, the ground is muddy, and you cannot see immediate results. But when the sun returns, the seeds you planted in the rain will grow into the strongest, most resilient trees in your financial garden. I'm incredibly glad you raised this question today. Learning this core behavioral lesson before the next market storm ensures you protect your tomorrow, today. Please remember, investments in the equity market are always subject to market risks, and it is highly recommended to consult a qualified professional before making major shifts in your strategy. This is Investment Dada, signing off. Stay wise, stay disciplined, and stick firmly to your plan. Thanks and regards, Cost of Bishwas from Plan Future. Please visit our website at www.planfuture.in to connect with us for your structured, data-driven financial planning and mutual fund investments.